while back, I released a Q&A video trying to answer a lot of the questions that you all had asked me, but unfortunately I wasn't able to fit it all into one video. So I wanted to release this follow-up Q&A video to hopefully answer each and every one of your questions. I love the Q&A format and I had a blast going through all of your questions. Please let me know in the comments below if you enjoy these sessions and if you have any other questions that you might want to ask me for a future video. Thank you for submitting these questions. Let's dive into the first question.
What are your thoughts on portfolio diversification? What would you consider as ideal diversification? Well, I would say personally for me, I'm in the camp where I'm really trying to get my portfolio down to probably 4 companies, 5 at the most. Right now I have a few more than that. Some of those investments are really small, and honestly, I don't know why I have a collection of small companies. I think it's because as I keep contributing to my base, sometimes investments will either rise in value to a place where I want to keep holding on to them, but I don't want to add more to that position. And if I find a new idea, I might take a small initial start and then continue to build it from there. So yeah, I'm a firm believer that, well, not only do I not have the intelligence or the attention span or the experience to, track more than maybe 10 companies at a time. Even 10 is going to be really difficult. That's why I'm trying to get down to that 3, 4, or 5 number. Now, ideally, I would like to say that, 1 stock is enough for me. I've never actually been in that position, so I can't actually say from experience, but I have been as little as 3 stocks in my portfolio before, and it was just fine for me. Basically, Warren Buffett's approach of asking the question, why would you put any money into your 20th best idea, your 15th best idea? And, in the case of unless your best idea has gone up in price dramatically and you think it might be getting close to a fully valued price, then there's no point in adding to any other position instead of the companies that you already know really well that are in your portfolio already. Now, ideally, I wouldn't own, a heavy concentration in one sector, such as 4 banks or something like that. But maybe having a portfolio made up of some of the tech giants might be enough diversification, even though they're all technically in tech. Google, Facebook, Apple, and Microsoft or Netflix might be a portfolio that'll knock it out of the park going forward. So yeah, I would say the maximum that I want to have in my portfolio at any time is 10, and ideally I'm trying to get down to 4 or 5 companies. Monish Pabrai has 10 companies in his investment partnership, but he says that personally he only never holds probably more than 3 or 4 stocks. And that's kind of the place that I'm trying to get to. A really comfortable and deep understanding of a few businesses that I think I can understand the future of that business really well. I think there's more downside protection in that notion than any sort of diversification just through broadly buying a bunch of companies that you don't actually understand. I have a video where I talk about this more in depth over here if you want to check that out. Akshay wants to know about my full-time job as a software engineer, and also if I have a favorite company that hits all my checklist items and that I haven't invested in yet. So for the first part, yeah, I'm gainfully employed as a full-time software engineer. I mostly work on UI, so I do a lot of front-end work. I can't really talk about the project I'm working on because it's proprietary information for the company, but programming is a lot of fun. If I have to have a full-time job, then it's definitely going to be programming. You get a lot of creative freedom, and I love my team that I work with. So I think sometimes it is a difficulty to have a full-time engineering job because I do feel like it is pretty draining by the end of the day. And then if, say, I want to do some investment work, I'm pretty tired at the end of the day. So one thing I've started to do is before I start work in the morning, is to get any reading done that I wanted to do to explore about companies or any new books that I'm trying to figure out. So it's a good balance. I don't want to give it up yet, but I am really enjoying having this YouTube channel as well. So we'll see where we go from here. There's a lot you can do to marry investing and finances with some software engineering. So I think the fields really do mix together, and maybe I can build something interesting in the future. And I'm happy to talk about coding as well. Maybe if you have experience with it, or you want to learn how, I've always got great resources for how I would go about learning to be a web developer, for instance. So yeah, just feel free to leave any comments or message me on Twitter if you want to know more about that. Then as far as the company goes, I don't know if there's one that hits all of the boxes just yet, but the one that I'm leaning closest to right now is Tencent. It's a competitor of Alibaba, but it's basically a part of the backbone infrastructure of China. There's WeChat and all the financial services that hover around that, and the e-commerce offerings as well. There's the investment portfolio that includes stakes in companies like Pinduoduo, and there's the fact that Tencent is the largest video game company by revenue. They're just a powerhouse, and I don't think they're going anywhere in China, and I think there's too much reliance on them for them to disappear. But that being said, I'm still definitely studying Tencent. That's why I can't say that it checks all of my boxes, but it's definitely the closest one that I am to possibly making another investment in. Joel wants to know if I've had a look at the projected demographic shifts in China and what it'll mean for players like Alibaba, JD, Pinduoduo, and Tencent. If the middle class is going to grow 10 times in number of people and the amount of disposable income of people in this bracket is also going to grow, are projections of growth in revenues of the companies understated? That's a great question, and to be honest, I can't predict it. I don't know what's going to happen. But I will say that if middle income spending does become a larger proportion of the Chinese economic spending habits, I would say that it benefits all of the companies. Li Lu talked about this a little bit earlier in the year when he gave a talk, and he talked about how the middle income class is going to be rising in the future of China. And to be honest, that only bodes really well for e-commerce in general. Now, I don't know necessarily if the revenue is understated, but I do think that the future value of the companies are very understated. So possibly that is an implication that the revenue is understated as well. And as middle income spending rises, it would probably make sense that a lot of spending will happen in the service industry as well. So it'll be interesting to see how companies like Alibaba will leverage, say maybe a grocery delivery business to try to capture some value there. I don't know, hope that helps, and if that was coherent at all, I'm not sure. Zurifi asks, if you were able to compound 6 days a week instead of 5, would you consider it an advantage? And by this, I think he means if the stock market were open 6 days a week instead of 5, would I call that an advantage? And to be honest, this sort of touches on the notion that I ideally would only check my stocks, once every quarter, once every year, something like that. I don't think that there's any behavioral advantage to being able to make portfolio changes at a higher rate. I think it would actually be structurally better for everybody's investment future if you could only make investment changes once, to be lenient, once every week. But ideally, once a quarter might be the honest best policy. So in practice, it really doesn't matter to me whether I can access the markets on a Sunday or on a Wednesday. It doesn't matter. If I've bought a company and I think that it's going to have a wonderful future, then it shouldn't matter, how often I can check my stocks. In fact, I think it might negatively affect my behavior if I could check the stocks on the weekend, because not only would I not have my job to keep me occupied, so I would more than likely be in my investment app a lot more, possibly making dumb changes that I really wouldn't if I didn't have the free time to fiddle with it. Okay, Motokur asks 3 different questions. The first one, summed up, he says, Guru investors invest in companies with wide moats, but companies with wide moats are usually in mature and stable stages and not in the growth mood. So how do you balance this idea? Then he gives the example, Coca-Cola has a very wide moat, but the share price has only increased 30% in the last 5 years. And contrast that with medium-sized growth companies that have grown much faster. Companies like MasterCard also have large moat, but they grew 300% during the last 5 years. And then Square, which potentially has a smaller moat than those other companies, has grown by 2,500% during the last 5 years. The most important thing about all of this is you really want to investigate the free cash flow that each company is generating. Coca-Cola's price to free cash flow is about 19. MasterCard's price to free cash flow is 58. And Square's price to free cash flow is 810. The questions I would ask about this are, what are the predictabilities of the free cash flows that each of these companies are generating? And are they trading at a reasonable multiple to those free cash flows? And what is the durability of the moats of each company? So in this example, Square has grown by the largest amount in 5 years. But my question is it justified? You seem to assess that the moat is smaller, if it has any at all. So you bring up a really good point. Of course, I would be happy to have bought Square 5 years ago, knowing now what we know. But even back 5 years ago, let's say in 2016, the price to cash flow was about 72 and the PE was 137. That's not a business that I would be investing in regardless. So there are going to be a lot of times in this business where you miss out on opportunities, and I think that's perfectly okay. Coca-Cola can be counted on to bring in those earnings year after year, and they also provide a very healthy and reasonable dividend as well. So I would say that it would have been really hard to justify buying into Square back when the company first came out in 2015. It just wouldn't have been on my radar as something possible. And I think that there are a lot of lofty expectations built into the share price of Square that might not end very well for the future shareholders of the company. I haven't studied Square all that much, but it does look quite overvalued. I mean, egregiously overvalued, if I'm going to be honest. So I would say that of all the companies that super investors buy into, which companies do you understand the best, and which ones would you be comfortable holding for decades at a time? Because it doesn't matter if you don't invest in Square. What matters is that you meet your investment goals. Next, do guru investors invest in stable companies only because they have large capital and they put protection over growth as a priority? Well, I can't speak for all the guru investors, but one trend I'm seeing in, for example, Guy Spears' portfolio is that he is most definitely leaning towards a preservation mode as opposed to a growth mode. Somebody like Monish Pabrai, though, is very happy to go for the growth investment opportunities. He's recently invested in Alibaba. He is invested in Resos in Turkey, which is a tiny little company, but he thinks it's going to be a multi-bagger going forward and that there's great capital allocators at the helm. And Guy Spear probably wouldn't touch any companies in Turkey, but Pabrai is willing to go there because he sees such great value. Once you have so much money in your portfolio, it actually becomes harder to find these growth opportunities. For instance, Pabrai is only able to put a small percentage of his fund into that wonderful company in Turkey that he found. But if I were to invest in it, I could put my whole portfolio in there and it could potentially change my life. So I think there's a balance out there, and there's examples of both types of investing for the super gurus. And then for companies, for Graham nets, is trading volume a factor in the equation or not? I'm not entirely sure that trading volume directly impacts the net investment. I mean, you want enough trading volume where you'll actually be able to build a stake in the company. But if you're a retail investor, chances are there is going to be enough volume for you. But as far as trading volume and maybe something like momentum investing, that's possibly something that might occur. Momentum going forward might be a catalyst, buying momentum and increased trading volume might be a catalyst that spurs the share price back to its intrinsic value. On the flip side, if there is no trading volume, then that company might just continue to sink into obscurity and it might never reconverge to its intrinsic value. So there's a give and take there. But for nets, the main focus are the assets on the balance sheet. What is that company, if liquidated, what will it be worth to a buyer on the open market? There's another question about YouTube from WJ. He asks, what video editing program do you use to make your YouTube video? I like your video format and would like to recommend it. Okay, so I use Final Cut Pro, which you can get a 90-day free trial from Apple to use Final Cut Pro. It's really easy to edit if you have a Mac, so that only works on Mac. But I actually started out using DaVinci Resolve, which is a free editing program that's pretty much as robust as Final Cut Pro. It was just missing a few features that I really liked, the magnetic timeline in Final Cut Pro, so that's why I decided to stick with that. So if you're editing on PC with DaVinci Resolve, you actually need a pretty powerful PC, or else you have to create proxy files for all of your videos, which isn't too bad, but it adds a lot of time to the editing process. So if you have a good enough computer and you're trying to get into it for free, definitely check out DaVinci Resolve. But if you already have an Apple computer, then even if it's not a very powerful Apple computer, you can give Final Cut Pro a free 90-day trial. There's also iMovie, which is a little bit less robust, but that's free, and you can do pretty decent job editing on that as well. It seems to me that a long-term strategy must have some sort of investment in China or at least Asia. I've shared this perspective with my friends, but I sort of get the side eye. What are your thoughts? Do you think it's wise to invest in China now and hold and then reap the benefits later? What are your thoughts on buying actual yuan now? So I'm not going to buy the currency, I'll tell you that. But I think it is pretty wise to make an investment in China. For me personally, I've done it. I own Alibaba shares. I'm considering buying shares in Tencent. I do have a lot more research to do on both companies. I'm not going to reject Chinese companies out of hand just because they're in China and there are, several risks. But China isn't the only place. There's Japan. Japan has a ton of wonderful companies. The entrepreneurship scene seems to be just now getting started there. And then a bunch of different companies, a lot of value to be found in South Korea and many other countries. So I'd say part of being a value investor is sort of getting the side eye a lot and, having what I might say unconventional views that others might come around to in the future, but then it'll be too late by then. So I'm not telling you what companies to buy, but I would say that I'm definitely hunting in Asia as well. What's my biggest regret in my investment career? Okay, yeah, back in, I think it was 2016 or something, I hadn't been investing for very long. I bought some shares in Valeant. Now, Valeant Pharmaceuticals was an irreputable pharmaceutical company. Charlie Munger said that it was basically a sewer, but there was a notable investor, Bill Ackman, who was very heavily invested in Valeant. Now, I thought I was being contrarian by following Ackman into this, going against old man Charlie Munger's words. I didn't lose my whole portfolio or anything like that. It wasn't a huge investment, but I sort of betrayed the fundamental approach that I had been following till then and what I try to follow now, which is investing in a business that I believe has excellent long-term prospects. It's like investing in casinos and whatnot. It's just something I should have never touched with a 10-foot pole. And the fact that I followed Bill Ackman into it, who, at the time, I didn't even really understand the company. I was just coattailing Bill Ackman purely. So it was a double strike of not knowing what I was investing in and investing in something that was doing something irreputable. So yeah, that was a big hot stove moment where I sat on the stove, and I'm never going to do that again. So, well, hopefully let's never do that again. It also reinforced the fact that I should probably, at the very least, listen to what Charlie Munger has to say. Every word.
Well, that's it for this Q&A session. I had a lot of fun recording this video, and I hope you learned something as well. Thank you so much for watching this all the way to the end. I really appreciate your time. Please like the video and subscribe to the channel, and I will see you in the next video.